For years, mortgage lenders have aggressively adopted digital point-of-sale systems to modernize their applications. Yet, there is an operational paradox at play. Implementing these consumer-facing portals often increases borrower drop-off and fractures data, rather than streamlining the process. Looking at a standard digital mortgage pipeline, we see two specific leak points. First, high abandonment rates during initial borrower intake. Second, systemic data transfer failures between the point of sale and the loan origination system. To understand how to solve this, we can look at the case study of a mortgage branch led by Abdel Khawatmi. Facing intense pressure from real estate agents and local market challenges, the branch executed a complete workflow overhaul to fix these exact pipeline failures. Their initial steps were drastic and entirely counterintuitive to standard industry practices. They abandoned their automated borrower self-registration portal and intentionally reduced their sales team, offboarding those with low activity. These cuts produced immediate financial and operational results. By contracting their operation and removing redundant software, the branch cut software costs by 50%. Because the system lacked integrated disclosures and a reliable sync protocol, data packets moving between the POS and LOS frequently got stuck and siloed in the middle. The result was mismatched loan numbers and completely isolated document storage. To compensate for this broken pathway, processors were forced into repetitive manual data entry loops. They had to constantly retype borrower information just to keep the two disparate systems aligned. Branch leadership identified this systemic drag as a failure of both the technology and the personnel enabled by it. The fragmented system allowed team members to obscure poor performance. This triggered a massive staff reduction. The branch systematically offboarded loan officers who exhibited poor call activity and weak conversion rates. Reviewing the new organizational structure, they removed the sales manager role to flatten the hierarchy. This enforced direct accountability to branch leadership. With the hierarchy flattened, they executed a consolidation strategy. A key team member, Trevor Borger, was promoted to a unified loan officer assistant role, merging both business development and loan processing functions into one position. Following this restructure, Abdel retained primary responsibility for 80 to 90% of the branch's production. This ensured strict quality control and protected crucial relationships with real estate agents. You cannot optimize a pipeline if the people operating it can hide by fragmented technology. Shrinking the team exposed the true process bottlenecks, preparing the branch for a unified software system. The branch's second counterintuitive move targeted the front end of the pipeline. They removed the automated borrower self-registration portal. While online portals are marketed as convenient, forcing borrowers to self-register and navigate data entry alone was actively causing consumer fatigue. It created a point of drop-off before an application was even completed. They replaced this with an admin-led phone intake process. Now, team members enter the data directly using the LEO Quick app while actively on the phone with the consumer. This flow comparison shows the mechanical advantage. The self-registration path introduces friction and ends in abandonment. Direct admin-led entry secures the foundational data layer on the first try. The technological engine making this data capture possible is the LEO platform. This system architecture provides a core technical upgrade. LEO maintains a continuous, real-time, bidirectional synchronization with the Encompass origination system. This architecture resolves the legacy bottleneck. A loan file started in LEO mirrors into Encompass within minutes, completely intact, requiring no manual duplication from processors. LEO also consolidates more than the point of sale. It brings the automated underwriting system and initial pricing disclosures into the same unified interface. By controlling the exact point of data entry and ensuring instant, bidirectional system sync, the branch eliminated the primary causes of lost revenue, consumer fatigue, and data mismatch. Once initial data entry is secured, the workflow shifts to document collection, historically a high-friction process of chasing down W-2s and pay stubs. This logic gate shows the automated workflow in LEO. The system triggers specific document tasks based instantly on loan characteristics. For example, executing a SmartPay soft pull automatically assigns tasks for W-2s, pay stubs, and IDs. The intake process then adapts to borrower preference. Clients can submit these documents via a secure portal, text message, or email. All inputs route into LEO's central task manager. Loan officer assistants can then convert these varied inputs into standardized, correctly stored documents. This removes the technical friction for clients who are resistant to using digital portals. However, migrating to a centralized system carries high operational risk if deployed aggressively mid-pipeline. To mitigate this, the branch utilized a specific transition protocol. They started exclusively with simple, conventional loans. This allowed the staff to build muscle memory in LEO without risking complex deals. They also maintained a dual system approach. Keeping both Legacy Blend and the new LEO system running provided a fallback to prevent operational failure. This rollout was paired with an ongoing feedback loop. Technical support provided dynamic video documentation to leadership to constantly refine the new processes based on real branch activity. Digital transformation requires a strictly governed, carefully phased rollout that protects live revenue while systematically retraining the staff. Zooming out to examine the optimized branch architecture, it functions as a single, frictionless data ecosystem. This network supports new external capabilities. A referral portal allows realtors and financial planners to directly inject purchase contracts into the stack, strengthening outside partnerships. Internally, this consolidated, synced stack provides branch leadership with clear, configurable KPI dashboards. This dashboard makes specific metrics instantly visible: real-time pipeline flow, credit pull volume, and precise conversion rates that the legacy system obscured. These analytics serve as the enforcement mechanism for the branch manager. It provides data necessary to hold the remaining core team to a standard of ridiculous accountability. Establishing this bidirectional data stack is a prerequisite for the next phase of lending technology. Future artificial intelligence integration is simply impossible if a branch's underlying data remains siloed, fragmented, and reliant on manual entry. By ruthlessly cutting bloat and unifying their origination architecture, this branch solved today's margin squeeze. In the process, they built the data architecture required to adopt AI-driven lending tools and maintain a competitive edge.